Good morning. My name is Adishan Nadu. I'm from the Global Markets Retail Investment Team. I'm joined once again by Tom Gale, Executive Global Markets Trading. Tom, good morning.
Good morning, Adishan.
Well, thanks for joining us. As we know, the market pulse, and it's got a slightly different view today, more conversational, a few topics to bring to the clients. Let's jump straight into it. First one, global geopolitics. Tom?
Yeah, indeed. In fact, if you were reading, watching or listening to the press over the weekend, you'd be forgiven for getting a little bit down and concerned about things because there was a lot that we heard that was militaristic. Perhaps you might even say alarmist, but such is the tense world we live in. So what I'm getting at is, first of all, those Ukraine strikes deep into Russian territory that threatens to escalate the conflict. It's not the first time we've seen this kind of action, but considering that the two sides are attempting to be brought together for talks brokered by the US, this will make it a little more difficult. Of course, the Gaza situation, the terrible situation there, continues to deteriorate. But in particular, as far as markets are concerned, we'd be watching statements from the UK. They made statements over the weekend saying that it was time to prepare for war. Now, as I say, that's somewhat alarming.
It's quite a big statement.
Okay, so let's consider the context there.
Yeah.
They were the British government was preparing to publish a strategic defence review, which was released today, and when you are looking for spending allocations at government level, you need to lead with a tagline that will deliver as you hope. Also, the British government will be very aware that there'll be the White House listening in to their military spend plans. And the other thing that I should add is that for a developed world that is desperately looking for growth at the moment, there is some logic in spending on the military, which could add a few percentage points of economic growth. So we could be cynical about this, but it doesn't come from nowhere. It's no good that in a peaceful world the British government looks to ramp up military spending. This certainly happens in a world where there is heightened military tension. There was also a summit last week and continued into the weekend in Asia, what's known as the Shangri-La dialogue, and some of your audience may have caught comments from the US Defense Secretary Pete Hegseth at that conference, warning the audience of an imminent attack on Taiwan by China. So the choice of words there is interesting because it suggests that it's sooner rather than later. Yeah. And we all of course know that the Chinese consider Taiwan not as an independent country, but part of the sphere of control of the mainland. At the same conference, the Australian Defence Minister had highlighted an extraordinary, he said, military build-up by China. In fact, the Australians are concerned that it is the single biggest increase in military capability since the Second World War. So anyhow, I think your audience gets the message here. It is a world that's increasingly dangerous, and wars are typically started by some sort of miscalculation when military readiness and deployment is at an advanced stage. So we're heading into that kind of phase, but let's relate this back to markets. As I said, there is potentially an implication for growth. Okay, it may be that that Europe, as we saw from German plans a couple of months back, where they themselves, the Germans, announced big military spend plans. It can be helpful for the economy. So that could be a tailwind for global growth. And we're not yet concerned that war is going to break out in the next few weeks or months. It remains an odds against probability. And in fact, in the meantime, we're comfortable that what we consider to be a bear market bounce, a bear market rally for global markets and risk appetite is intact and will probably remain intact through June. Okay, so
well, as you said, it's intact till June, but I mean, I don't want to jump the gun here. That brings us to point two. And point two is a big one because there's a lot of news coming out, and I mean, seeing something just come out now as well with trade truce being violated, etc. So there's talk of war and there's talk of tariffs. There's a lot going on, but let's tie into point two, which I think we touched on briefly. And I mean, you did bring to the audience attention last week, the July or August event risk. We don't actually have a slide on it today, but if you can just give a refresher to the audience.
Yes. So I didn't want to share what we talked about last week as a slide, but it's worth reminding you and the audience that we do see that there is risk that builds into July, August. It's traditionally the case that markets experience challenges and sell-offs when pressures are building only in September or October, and the reason is because a lot of the northern hemisphere is away on their summer break in June and July, but we think that there's reason this time around to be a little bit careful, cautious. You'll recall from last week's session we discussed what happens in July. That is the Republican set deadline for the tax bill enactment, which would add to the to the fiscal burden in the US. There's a debt ceiling agreement that is required then, otherwise the federal government will run out of cash. And of course in July also the moratorium on reciprocal tariffs will expire, will lapse, and so the tariffs could be reimposed, notwithstanding some of the legal and court rulings that we've seen recently. Let's not get into that now because that's not what we want to do. But I just want to sketch a picture that that shows we think that risk assets will be fine for now globally, for now and possibly through June. But as we head into July and August, the risks increase quite significantly. So we'll take each week as it comes. At the moment, we're okay for now.
Well, and that ties to, I mean, today's price is quite a jump there. 3374 I have on my screen, but that's just the gold price. But we've got commodities in general. Let's touch on that and exactly, I mean, especially in this time of crisis, what exactly can we expect to see, or what exactly are we seeing actually unfold?
Okay, so when we talk about commodities, there are, as you allude to, there are different ways, different types of commodities which serve different purposes. Gold, that you mentioned, currently sitting around $3,350 an ounce, has rallied again, and that does reflect some of the risk premium in markets surrounding the global geopolitical tensions that we talked about. Okay, and just to remind your audience, we remain long-term bullish on gold. And if you want to try and time your purchases of gold, and remember that you can get exposure to gold through Standard Bank's ETF, and the ticker, the JSE ticker there is ETFGLD. That if you're timing the pullbacks, again, 3280 and 3140 would be the levels, the support levels that we typically see gold bounce off. Okay, so that's gold, but we're not just talking about gold.
Correct.
We need to also mention oil. Now, oil's an interesting one because on the one hand, it trades as a demand indicator, global demand indicator. So if global growth has been slowing, or there have been risks to global growth, you tend to see oil sell off, and that's certainly what's been happening recently over the last few months and so on. And of course, it's a supply story, and for those following what OPEC's been doing, well, at the weekend they announced, OPEC plus group of oil producing countries announced for the third straight month in a row plans to increase production and supply of oil onto the global market. So that also serves to depress prices. There is one caveat, that oil can also be sensitive to geopolitical tensions. We've talked about that, and that is the one consideration that is just stopping oil from falling quite precipitously. We do feel that Brent crude could pull back to about $50 a barrel. We think that there's a distinct prospect of that at some point, but it's probably a story for the next 3 months rather than a story for the next month or so. So that's oil. We could also talk about copper, where we've been very constructive over the long term. It's a metal that is key to the global energy transition. And we have copper in deficit in a 10-year view. There just aren't enough copper mines, and they're very expensive to build or to buy. So the price of copper we continue to think is well supported. It's also well supported when the market is concerned that there could be tariffs applied. And we've seen a big jump in COMEX copper prices in the last 24 hours following President Trump's announcement that he planned to double tariffs on steel, for example. So the market's always very alert to supply or tariff disruption to metals as well. That's really all I want to say about commodities today in this session. We do consider commodities as increasingly more important for markets, and in fact we go as far as to encourage any sensible portfolio to diversify into commodities, but that's a conversation we could have for another time.
100%, and I mean it gives good outlook there, and to your point, it's a nice little GLD kind of indication to the audience, if in case they didn't know. And
yeah, can I just come in there? I just need to talk, because let's just be clear, the instrument that we're suggesting, which is a very low cost way of playing gold, effectively physical gold, but you don't have to hold it yourself. The ticker is ETF GLD. Yes. Okay, so let's just be clear: Echo Tango Foxtrot Golf Lima Delta. That's the Standard Bank ETF, and it's backed by real metal in vaults in London. It's a very low cost way to play gold exposure.
Well, that's exactly what. And then if we move on to, let's jump to point number 4. We always do mention the USDZAR or the dollar rand. Normally have some charting, but let's just unpack that for a bit, Tom.
So the point about gold and the gold price remaining high is directly relevant for the rand, because, as we've discussed in previous sessions, export receipts are predominantly made up in South Africa of gold and PGMs, platinum group metals. So if the gold price is high, that means we're earning more dollars as a country, and so too platinum and the PGMs. Platinum is a little softer right now. We did anticipate something of a breather for the platinum price, given all the hype around London Platinum Week last week. But we still feel quite constructive on platinum too. So taken together, gold and platinum supportive for the rand. Now, we did see a bit of a blip in the rand on Friday. It was somewhat curious. We were also a little unclear what was causing it, but there were certainly some flows in the market on Friday late in the day that forced dollar rand back above 18. You'll recall that we remain very constructive on the rand, and so once again we would encourage the audience and investors more broadly to sell dollar rand spikes, as we would call it. So above 18 and towards 18 and a half, you sell dollars absolutely. The dollar rand will eventually settle down towards 17.50 or thereabouts, and that
while we're
actually.
chatting right now, you correct me if I'm wrong. I think we're trading at around 17.92, 93, if I'm not mistaken. Could be wrong. From what I
Well, you're
see
not.
on my screen.
Well, you're not wrong. No, you're not wrong. That's where it is. That's right. As I said, there was some anomalous price action on Friday evening, which took the dollar rand back above 18. Once again, it was driven by some unusual flows, typically that are seen at month end, and it's really forced an emotional flow. But as you rightly point out, the dollar rand is comfortably back below 18 this morning, where it should be, and it will continue to grind towards 17 and a half. Now, I want to just segue into the fifth talking point here, which is the South African Reserve Bank, and why our dollar rand call is also tied very closely to what we heard last week from the Reserve Bank. Not only did the Monetary Policy Committee agree to cut rates, it was interesting actually that one of the committee members voted for a 50 basis points, half a percentage point rate cut. We only got the quarter of a percentage point, but it's interesting that they all wanted a rate cut, and one of them wanted more than the others, and that to us is a little bit of change of narrative from what we have been used to over recent months, where the Reserve Bank had remained very hawkish, that is to say, very reluctant to cut rates, but now seem to be a little more comfortable that that's the route that they could take. And part of that is informed by a report that the Reserve Bank published or commissioned and then shared last week around plans or proposals to change the band or the target for inflation. Now, since the early 2000s, the Reserve Bank has had a mandate to control inflation within a target range of 3% to 6%. But as you and your audience know, inflation, consumer price inflation, has been printing actually below 3%. I think the latest print was 2.8%. And so actually it's dropped to below the target range. And it's no secret that Lesetja Kganyago, the Reserve Bank governor, and his team have had designs and ambitions to actually bring the inflation target lower. Why would it matter if inflation is already lower? Well, because if the message from the Reserve Bank is that they won't tolerate inflation above a certain level, then that extends through to public wage negotiations and so on. And so what it does in effect is help anchor inflation expectations. So where I want to go with this, what I'm trying to say is that although it has not been mandated, the Reserve Bank has clear designs on bringing the inflation target lower, possibly to 4.5% in the interim, eventually to 3% as a point target. That would assist in anchoring inflation expectations. And here's the crux of this, that if you take our interest rates and you subtract our inflation rate, then you end up with what we call a real interest rate adjusted for inflation. And that real rate is very high. It's a positive number. It's the difference, as I say, between our interest rate and inflation. And if real rates are high, it does suggest that it causes some constraint to the mobilization of money in the economy. So the Reserve Bank is starting to sound like they will acknowledge now, especially in the light of well-anchored inflation expectations, that there is significant room to cut rates. And if there's room to cut rates, that could add some GDP growth tailwind to South Africa. It's not going to come in time for tomorrow's GDP print, which we're expecting to be released by Stats SA. That GDP number tomorrow, is going to be very, very poor, very weak. we're stuck in a no or low growth cycle. But the Reserve Bank may at last be coming around to the idea of or may have more capacity to cut rates. So that's something that we're watching closely. And I think that Adi, for today is a summary of what we're thinking.
No, but so just to touch on that, just before we close, just to give the audience a little bit more, I'm hoping from your side, Tom, is we expected, and as you said, we mentioned in previous pulses, there's a bear bounce. I mean, we follow the U.S. economy quite closely, but what you're speaking about now in terms of what's happening locally, we can expect to see, I mean, given the bear bounce, we will, as you said, and you've mentioned it, there will be some tailwinds and there'll be some correlation to our market. But given what you've said now, based on what, and hopefully the Reserve Bank does follow through, that could be positive for our market, right? In a general sense.
So I don't
Or
want to get
equity
into
market.
So I don't want to get into a detailed discussion at this stage, which risks which risks losing the audience. Certainly, last week's Monetary Policy Committee meeting was a momentous event. Momentous event in the sense that they have now started signaling to the market that inflation will be anchored at a lower level, and that has direct implications for our bond market. So we've seen a lot of very interesting price action in our bond market last week, and again, this is not the forum to discuss this in detail. The equity market would be less immediately sensitive to this, but in the longer term, if there are rate cuts that follow, then the equity market could benefit. For now, we are feeling a tailwind in the bond market. Equities already hovering around all-time highs have had a good run. We still think South African equities are cheap and will fare better in a global sell-off than perhaps US markets. And so remains a good place for your cash, but of course we're not immune to a sell-off either. But I think let's give further consideration in later sessions to what the Reserve Bank is expected to do.
Well, let's leave it there. And once again, Tom, it's a very insightful session, and hoping this gives some clarity to the audience. And we appreciate your time. So we'll chat again next week. And thanks a lot.
Thank you.